How's it going? Brian here with Midwest Market Solutions. This is our latest internet video series. It's been a while since we've had a time to put one of these up here, but we hope to get these on more frequently. Today is July the 19th, and this is being broadcast here and uploaded to the internet on this day. Let's go first through some of our disclaimers here, and then we'll talk a little bit about what's going on with the markets today. We're going to talk on Commitment Traders report and the importance of that report and what it's showing here recently. There is a risk of loss in trading futures and options, and that is substantial, and every investor trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical results of strategies, is not indicative of any future results. Trading advice is based on information taken from trades and services and other sources that we believe are reliable. We cannot guarantee the information is accurate or complete, and it should not be relied upon as such. Trading advice reflects our good faith judgment at a specific time and is subject to change without notice. There's no guarantee that the advice we give will result in profitable trades. It is everything that you hear is copyright Midwest Market Solutions 2015. So with that out of the way, now let's focus on the Commitment Traders report. And as you may know, if you followed us for any period of time, we focus in our weekly newsletter on this report, a special section dedicated to the raw numbers of what the funds and the commercials are doing. Plus, we also throw some charts in here to make it more aesthetically appealing than just looking at charts and graphs. And so, instead of just looking at the raw numbers, so let's look at some of what we've got going on here. This is a chart of Chicago wheat, and here is the price levels that we focus on. And this is a weekly chart because the report comes out every week. What I've noted here is major commercial selling at a peak when prices were high and started to move lower. We've noticed here's a good spot of major commercial selling. You notice how the prices move lower after the commercial sold. Major commercial selling as the market rallied, and then prices move lower. Here we have noted where commercials were into a bullish category. This is back in September of 14. And notice how as the prices started to bounce off of some support and had a nice rally, usually what we get is commercial buying, which is this dark red line, against fund or large producer, large spec type selling. And of course we get the opposite sometimes, commercial selling against speculative buying, and that gives us the markets that we trade in currently. So that's why we are looking at these so closely. This chart here is our large spec index versus our commercial index, and these are done on a weekly basis. So what we look at in this respect is what are the speculators doing, what are the commercials doing. And one thing I'm going to add into this chart here to even break it down just a little bit farther is we want to look at what is the sentiment doing in here. What in this index we can look at what do a lot of the trade, are they bullish or bearish, and that almost perfectly mirrors what the funds are doing. As you notice, the blue purple lines overlap and are just perfectly in line for the most part throughout the market environment. So what the public does usually is follow what the market does. That's exactly what the speculators or the funds do, is they follow the market. As the market starts to rally, you can see they were short here at the market bottom, and then they started to buy back till they went long, and that was right near the top of the market. So these guys don't usually do the best job of trading, and a lot of the public sentiment anyway is the same way. Most people are really bearish, which would be a zero reading down here at the market bottom, and get more bullish at the top of a price level with 100% accurate rating. So this is a wheat, and we can see the commercials are extremely bullish here around weekly support around 469 or 470. That was back in September of 14. The funds and the speculators, the commercial index, just the sentiment index, all extremely bearish, which tells us this was probably an opportunity for the market to rally. Now what we would try and do in here is for our producers and speculators is to buy this market or re-own. Conversely here we're getting to a point where these two signals were showing an extreme sentiment of being bullish. Right near the top, commercials were selling into the market and going short. And that's the general pattern that we try and follow, is get these things to match up as much as absolutely possible. And once they do, that should be an indication of a change or a turn in the market direction. So if you're a trader that likes to use options, if you are a producer who's looking to hedge or re-own, this is a really valuable tool that we love to use on a regular basis. The final thing that we want to point out is we've talked about the raw numbers here of commercials versus speculators. We've talked about the index numbers here. We go to this bottom chart. It's our commitment of traders change index. And what this shows is on a weekly basis, are the commercials big buyers or big sellers? Now you see these small bars here. Shows us not much activity going on in this time frame. We didn't see much change from one week to the next. But look at over here where we saw a huge red bar on June the 12th. That's a major selling going on in 1 week, and the commercials happened here on July 3rd. Commercials were huge sellers in the wheat, and that usually, when we get this huge selling, usually you're going to get huge buying, and you don't get a lot of that on back-to-back weeks. Usually it's, you can see here, just 1 or 2 type days, 1 or 2 weeks of some big moves. Here you got some pretty big moves, and that's usually a sign of some sort of a selling exhaustion by the commercials. And if we were doing this to the funds, it would be the same type of thing, a lot of buying type exhaustion. So you can see we can use this on the bullish standpoint. Green means the bullish here. Commercials were big buyers here. There were buyers here, and there were really huge buyers right in this area. But because the other markets weren't set up, really didn't give us much of a signal. Here you maybe could have seen some sort of a signal here, and which is eventually led to the rally. Now the hardest thing to determine in these markets is when the timing is going to occur, because you're right here, you're in a downtrending market, as wheat is here in 2013. You're in downtrending market, but the commercials are getting into a buy mode. The speculators and the sentiment index is all in a bearish mentality. So when does this trend change? Well, you use a weekly chart, and you can see here we've held weekly support around 591, bounced around for some period of time, 3-4 weeks. So we went from January 10th through February 7th, finding support at this area, and prices rallied. So we try and use combination of weekly chart analysis to give you timing and as well as direction. So what's it telling us now that we've kind of explained some of this? Let's look at some charts. What's it telling us here? This is a Chicago wheat. We look at what's going on right now. Commercials have went to an extreme bearish situation on their index. If you look at the raw numbers, they're short 16,000 contracts. That's more than they were short back in here, where they were short about 14,000 contracts. And back in this area, they're short 29. So they could certainly go more short, but this has been areas that has stopped rallies in before, and we've seen this happen here. Huge selling by the commercials on July the 3rd. Looks like a top has been posted at this area for the wheat market. So all the funds, as you can see, they are now on the long side. They were short back in here, over 7,000 contracts. Now they're long 15,000. And based off this numbers, it looks like prices are going to retreat back down into this 470 area. So we've got a lot of downside because we're at 554. We'll keep in the wheat, but we'll go to Kansas City, because there's one thing I want to show you here. I identified the most net long positions in history right in this area. This was May 15th, and this was coming off of support at 499, and we ended up having at least a dollar rally all the way up to 611. This coincided with resistance right here. You can see at this $6 area, went to 611, big commercial selling, and it looks like the trend has turned back for Kansas City wheat here, as the index is really not set up. It doesn't give us clear signals, but this was pretty clear, and this is pretty clear that when we got to this $6 resistance in Kansas City, that was the time to bail out of any longs and go short. And now prices are at 546. We've dropped 50 cents already, headed for another 50-cent drop to this 499. So wheat outlook is bearish based off of this numbers. If we switch over to corn, we can take a look at that market as well. All right, so we're flipping charts. We get to the corn. Just to again notice, sometimes in here we see a big bearish move here in the commercials. It's coincided with some bullish optimism, which of course we think is bearish, based off of the commercial numbers in here, and this is back in April of 2014. So as the market rallied up and we saw resistance at this area, identified resistance, and lo and behold, the market rallied April 11th all the way through May 2nd, May 9th, and that was a top in the market. And you can see how we fell sharply. And the commercials never really did get into this buy mode of getting long. They had just let the market free fall. The commercial index never really got too long. They never got too bullish until the market found some support here in October, had a seasonal rally, and once again commercials quickly went to the short side. And that's another thing we want to mention is how aggressively they get short. You know, they didn't let the market rally back up into this area before they got short. They were aggressively getting short just on a small bounce in the market in here. So sometimes we can look at other features such as this chart gap, which never did quite get filled, retracement levels, those sort of things will give us a clue of how high this market's going to rally. But it didn't take long here in December before the commercials got short, really only a couple of weeks before the market started to drop again. Now you notice the commercials starting to get long in March. Of course, that was a little too early. There was some support here that the market had at the 397 area. It bounced around there and never took off and rallied. And then in April, it kind of fell out of bed to this double bottom support at 361. Now this is why we were calling for bullish conditions in this market here, and a rally opportunity into the summer is bullish right in this area. Again, another big bullish signal here coinciding with bearish activity from the funds and the sentiment index, and then we had the big rally. Went from 360 to 447. So that is a super rally, almost a dollar rally in what looks to be a bear market, right up into resistance here at this 447 area. And the market has turned back. You notice the commercials are big sellers in this area. On July the 3rd, huge sellers into that time frame. They continue to be sellers the last couple of weeks. And it looks like the market at least has made a temporary high right at this 447 resistance point. We'll look at soybeans here before we go. Bullishness was noted here in January. Had a small rally. Market did come back down into this 927 area and then pulled back once again. Went down to a double bottom at 891, 895 area. This is the lows that we charted last fall before we saw the market rally. Look how commercials were bullish. This was set up here. The market found double bottom support and gave us about a 3-week chance to get long. If you were able to look at double bottoms on the charts, see this as an opportunity to get long. We went from 891 to 1038 pretty quickly. So it's a $1.40 rally. That's about normal for summer weather rallies. Now you can see commercials quickly went bearish. Huge selling on June 26th and July 3rd weeks, big time selling, equivalent to the selling we saw back in here in 2013 on 2-week basis, as the market rallied up into this area and then fell off. Looks like we've made a high right in this 1038 to 1040 area, and the market is in retreat, and looks like it possibly will come back down into this $8.99 area, as a lot of funds are now long. They're long 107,000 contracts after being short back here at the end of May. They were short 55,000 contracts. So probably not much buying interest left by the funds. They're at their longest period since back here in April and May, when the market peaked out and topped in 2014. And yeah, it looks like prices are in a retreat here and turning lower. So as we sign off here, we want to mention that we thank you for your attention. We have 4 offices around the Midwest. If you like anything in the future as far as accounts to begin trading with us, contact any of our 4 offices around the country, or go to our website, midwestmarketsolutions.com, for more info. Have a great evening, everybody, and good week. Thanks for listening. We will be back again soon. This has been Brian Hoops.